Hello everybody, welcome back to another valuation investing video. And today in this video, I'm gonna be going over 3 high growth stocks that appear to be undervalued today, and I think that they could be a buy now. So with that being said, let's get into 3 stocks that I think look very interesting at a pretty good valuation, and they're growing very fast. The business fundamentals continue to keep growing and are expected to grow at fast rates. So let's get into these 3 stocks. So the first stock that I think that's a high growth stock and looks very attractive at today's price is going to be Hims & Hers. So Hims & Hers, if we go over here, we can see Hims & Hers stock. As we can see here, Hims & Hers is down 11% in the past month, and just yesterday the stock was down almost 15% because of some recent news over potential drug reduction in prices by Donald Trump and with the weight loss drugs. So with that being said, if that doesn't give a hint on what Hims & Hers does, Hims & Hers is a telehealth company that provides access to medical consultations, personalized treatment plans, and products primarily through an online direct-to-consumer platform. So with that being said, looking at Hims & Hers, as we said, a telehealth platform, but they focus on certain areas, mainly sexual health, hair care, mental health, dermatology, skincare, and weight loss. And weight loss is a pretty fast grower for Hims & Hers, but it's starting to slow down. As a result, because they used to be working with Novo Nordisk, which is the maker of Wegovy, they actually ended that partnership, and that has harmed their growth in that weight loss area. But Hims & Hers is still a very fast growing company and a very good company overall. Also, we have treatment and products. After an online consultation and evaluation, a licensed provider may prescribe prescription medications or recommend over-the-counter products. So they are shipped to the person and prescribed to them. Personalized care, they often offer customized solutions such as compounded medications. So they were compounding medications tailored to a person's specific needs and health profile. They were compounding the GLP-1s, which is basically the drugs for weight loss, and they actually had it at a cheaper price. However, that's starting to get harder for Hims & Hers as the FDA is starting to crack down on these compounded medications. So that is a slight risk to look at for Hims & Hers. And the business model is a primarily subscription-based model that includes the cost of the medication. So that's one good thing about Hims & Hers. It's a subscription-based model, meaning that the person that is using this their consultations and telehealth platform, they have to pay recurringly every month. So that's a good thing to ensure that the company continues to grow faster in the future and has steady growth. So with that being said, taking a look here at market-io, let's look up Hims & Hers. So looking up Hims & Hers, as we can see, the stock was down 14% just the other day, but the main thing I like to look at is the SWOT analysis. This gives us the strengths, weaknesses, opportunities, and threats of the company. First, let's look at the strengths of Hims & Hers. They have a strong brand recognition. They're very dominant in the telehealth area. They have AI-powered personalization, subscription-driven revenue, like I said, which is very good. They also have vertical integration with Hims & Hers controls key aspects of its supply chain, including telehealth consultations, prescription fulfillment, and retail partnerships. They also have very good financials and strategic market expansion. But the weaknesses here, regulatory non-compliance risk. These are probably the biggest risks, is regulatory by the FDA. They face pretty severe legal and regulatory challenges after Novo Nordisk terminated their partnership. Also, partnership dependency, margin compression pressure, recently operational complexity with the FDA. Like I said, mainly the biggest problem here is just regulation and legal problems with just the company as a whole. Also, the opportunities here is they have a lot of partnerships, expansion potentially in Europe, personalized treatment scaling, financial momentum, and guidance. Also, another big thing is menopause care market entry. They're starting to make a drug for menopause that could be historic, or can potentially help treat menopause. Also, threats, though, could be legal challenges. Like I said, basically just legal challenges with this company is the biggest fear. Now, scrolling down to the hedge fund institutions, we can see 66% are bullish, 34% are bearish. So that's actually pretty good for the bulls here. Also, if we go down down to the insider activity, this is another problem. The CEO has been selling some shares in the past few quarters, so that is a slight worry to me. And I actually owned this company before at about $25 per share, and I sold it in the 60s and 50s. So me personally, I'm definitely looking to potentially get back in, but I'm just worried about the regulations and CEOs and insiders selling. But with that being said, let's look at the fundamentals of hims and hers here, and we get with my 7-step stock analysis, I like to look at 7 key metrics that give us a good area for the fundamentals of the company. First, the forward P ratio. I want that less than 30, but it's at a very high valuation, 108, meaning their forward P ratio at 108 means you're going to be paying $108 for $1 of earnings per share in the next year. That's very high. Take a look at the return on invested capital, though, very good at 25.8%, so that's good. They're good at reinvesting back into the business. Also, the growth numbers look very good. Revenue growth 76%, EPS growth 250%, very good. However, shares outstanding are increasing. The debt to free cash flow doesn't look too good, so that's the only problem there. Honestly, I don't know why the free cash flow is so bad. Let's see the free cash flow. Free cash flow 198 mil, and then the total debt is 1.1 bill. So they do have a decent amount of debt you got to worry about here. So that keep in mind. But with the intrinsic value calculations here, let's do a bear case. I'm gonna do a bear case of 20%. Say with the loss of weight loss drugs, basically they're gonna start growing pretty slow and decelerate very fast, even though they're growing near 100% right now. Let's say it gets down to 20. Let's do base case 30 and then bullish case 40. Now, for the profit margin here, right now their profit margin's at 9%. I think bear case is going to be at 8%. Base case, let's do 12. Bullish case 16. I think they can increase these margins by a huge amount due to the telehealth nature of this company. So that could be a good increase there. Now for the future P ratio, growing at a 20% growth rate, that deserves at least a 30 P ratio. Let's do 35. Base case, I'm going to do 50. Bullish case, I'm going to do 65. Now for the shares outstanding, I think they're going to increase 3%. Base case, say they increase 2, and then bullish case, say they increase 1%. Because they keep increasing shares, it's a growing company, it makes sense they're diluting shareholders. With that being said, we get an annual return of almost 30% with the base case. So I could see these as pretty low numbers here. Say we reduce the PE ratio and even the growth rate. Let's see what we get here. We still get a 16% return at pretty conservative numbers, I believe. So honestly, the only thing that has me going against not buying back into this company is the regulation risks, and that's the biggest thing here. Are you willing to risk investing in this company due to the legal and regulatory risks? Because they have to go against big pharma, and it's going to be a struggle. So with that being said, let's take a look at the next high growth stock to buy now, and I have ASML. So these next two stocks aren't going to be insane growth stocks like hims and hers, but they're still very fast growing companies at more than double, higher than double digits, 10% growth rates. So they're still growing at a pretty fast rate, but they are definitely bigger companies than hims and hers. And I actually own these next two companies, so I do believe they're still buys nows. And the first stock is actually one that I've been buying as of recently in the past week. So number 2 is ASML, my second largest position. Looking at ASML, the stock is up 47% year to date, so it's doing very good. But I still think that you could be buying this stock and make a decent return today. And if you don't know what ASML does, they're a Dutch multinational company that is a key supplier to the semiconductor industry. They don't make chips, but they do make complex machines to make chips. So they sell these complex machines to companies like Intel and Taiwan Semiconductor in order for them to make efficient chips. So with that being said, looking here at ASML, they manufacture lithography machines, which their primary product in which uses light to print the incredibly tiny intricate patterns of a microchip circuit onto a silicone wafer, which is a foundational step in chip manufacturing. And this is the only company that makes these machines here, the dominant EUV lithography machines. They're the only supplier in the entire world that makes these machines, which is cutting edge technology to print the smallest and most advanced features for the most powerful chips. So that's why I really like this company. They have a huge moat big competitive advantage, the only company that makes this type of machine. So right now, they have a massive moat because they're the literal only company that can produce these very important machines, especially as the demand for chips get higher because of AI. This is very important. So with that being said, taking a look at ASML stock, let's look at the SWOT analysis here. Looking at the SWOT analysis, strengths is the EUV lithography monopoly. Like I said, the only company that makes these machines. They have strategic customer partnerships with Intel, Samsung, and Taiwan Semiconductor. They also have very AI-driven demand tailwinds and financial resilience. So those are some strengths. Weaknesses, overcapacity and delayed orders is slightly worrying, and geopolitical export restrictions is a slight problem due to the expected drop of 48% year over year due to China export restrictions. Also, we have high EUV machine costs. Honestly, not too worried about that. Even though they are very expensive, it is a must-have for these big companies. Also, we have customer concentration risk. They don't have a lot of clients, so that could be worrying, but I honestly don't think it's that big of a deal. And looking at the opportunities here, like I said, they're expecting very high growth numbers for 2030. That's the biggest thing. They're expecting anywhere from 13 to 20% growth in the next 5 years. So that's very fast growth each year, and that's why it's in this video. Some threats could be slowed demand and overcapacity, and like geopolitical risk and trade policy risks. Taking a look at the hedge fund and institutions here, 64% are bullish, 36% are bearish for this company. And taking a look down here, the actual amount of people buying and selling insiders is none right now. So not a lot of insider trading, which is pretty decent. Now taking a look at the 7-step stock analysis for ASML here, we have the forward PE ratio 38.5. Return on invested capital is check marks. Everything's a check mark here besides the forward PE ratio. And for some reason, the future revenue growth, however, that is just wrong. If for some reason showing a wrong number, the future revenue growth is actually expected to be anywhere from 13 to 20% from the company itself. So for some reason, this is showing 0.7%. In the past, it hasn't showed this, so that's interesting. So I don't know why that's like that, but they're still expected to grow very fast. So with that being said, looking at our bear, base, and bull case, if I put a bear case for ASML at, let's say they grow 10%, I think this is still pretty low. The company expects to grow 13 to 20%, so let's do bear case 10. Base case, let's do 14, bullish case 18. So I'm going to be a little bit conservative here, but still, I think these are fair numbers. For the future profit margin, their profit margin right now is at 30%, and they're actually expected to increase it by a little bit. So let's just do 29%, base case 32, bullish case 35. I think they can increase this by a lot, also due to the pricing power they have with their monopoly. Now for the future PE ratio, let's put a PE ratio for the bear case at 23. Let's do base case, let's do a P ratio of 28, and then bullish case, let's do a P ratio of 33. So with the shares outstanding, they're buying back at about 1%. So let's do 0.5% here. Base case 1%, bullish case 1.5%. And with that being said, looking at our intrinsic values here, we get about an 11% return from today's price with the base case. So I still think you can make a decent return on this company. It's a very high quality company, so I believe it could be still worth it to buy today. Me personally, my average price though is at about $660, so I'm not necessarily adding right now. If it gets under 900 again, I will probably add to my position though. So with that being said, let's get to the final stock. Now the final high growth stock that I think is a buy today, and I've been buying over the past few weeks, and it's my newest position, it's going to be Meta. As we can see here, Meta I believe is one of the best stocks to buy now. Even though it's still near all-time high, it's not down a whole lot from its all-time high. As we can see here, it's down 8% in the past month. 52-week low at $479, so right now it's still pretty high price, but I still think it's really worth it to buy this company. As we can see here, Meta Platforms, formerly known as Facebook, is a multinational technology conglomerate whose business revolves around two main pillars, social media apps and building the metaverse. So I believe that this company could have future growth of very fast rates and could potentially reaccelerate its growth. As we can see here with what Meta does, first, their main business is connecting people through their social media apps. As we know, they own Facebook, Instagram, WhatsApp, Messenger, Threads. All these apps and platforms generate a bunch of money through the digital advertising. And then the next thing is going to be for the future developing the metaverse, this could potentially really help Meta grow even faster, I believe. So they're creating a Reality Labs division which focuses on VR, AR, Meta smart glasses, and software and experiences. I think that this could be the next big thing. If they can really help this grow, this could really mean this stock is very undervalued and still growing very fast. And some other key areas is going to be AI for Meta and e-commerce. So with that being said, let's take a look at Meta. Taking a look here at Meta stock, the SWOT analysis here, some strengths is going to be AI leadership, because they've actually been offering a lot of contracts to big AI engineers. Also, operational efficiency, their margins are extremely high as of late, even with heavy AI spending. Also, their revenue growth has been 15% over the past 3 years. The past 2 years, it's actually been 20%. So they're growing pretty fast over the past few years, and that's why I added it to this list. Also, strong advertising dominance, 97% revenue from advertising. So that is a strength. Also could be a weakness though. With the weaknesses, we have Reality Labs financial drain. They're spending a lot of money and not getting any good return. They have some legal risk, which isn't too bad, and also CapEx spending is very high, 70 billion for AI infrastructure. Content moderation risk, AI competition pressures, and I honestly believe a weakness we're missing here is actually the strong advertising dominance. I understand 97% revenues from advertising, but during times of bad times, like say recession happens, companies like Google and Meta will be the ones mainly affected from the big tech stocks because of the lack of spending from advertisers. Once a recession happens, that's going to really hurt these companies. So with that being said, let's go to the hedge fund and institutions. 64% bullish, 36% bearish, so that looks pretty good here. Looking down at insider trading, there has been some selling from insiders, so that is a little bit of a worry. It's not been too much, but a little bit. So with that being said, let's go over to my valuation investing website. Let's look up Meta stock. So if we put in Meta stock and we go to the 7-step stock analysis here, we can see we get 7 out of 7 key metrics for Meta. So this is a very good fundamental company. Everything looks very good, from the growth numbers to the return on invested capital to the valuation to the shares outstanding and the debt. So nothing to complain for Meta here. So with that being said, let's do bear case 8% growth. Let's do base case, let's do 12, and then bullish case 16. I think these are still conservative numbers for Meta. Now, for the future profit margin, right now their profit margin is at 40%. So with the bear case, I'm going to do 36, base case 40, bull case 44. I think it's going to stay right around here because of it might even go higher due to them starting to make their own chips, which will reduce their spending on those chips. So this could actually get higher. For the future PE ratio for Meta, I think a good PE ratio could be 20, growing at 8%. That's a pretty decent valuation for a great company. 24 and then 28. So now for the shares outstanding, I think they're going to be buying back at about 2%. Actually, let's do 1.5%, because they had slowed down their buybacks, because those buybacks are slightly skewed from when the stock really tanked back in 2021 or 2022. So with that being said, looking at the intrinsic values, I get a 13% return from today's price, and this is why I continue to buy this stock. And if it goes lower, I'm definitely going to be buying more. So with that being said, thank you guys for watching this video on 3 high growth stocks, 3 undervalued high growth stocks to buy now. Please subscribe. I want to get to 5,000 subscribers by the end of the year. Please like and comment, and also click right here to go check out the Patreon, and see you later.